And we're starting off here with Dave. Dave, you're with Allworth's Money Matters.
Hey guys, how you doing?
Good. Thanks for joining us.
Thank you for taking my call. I have a question on direct indexing. I'm going to be having an investment be liquidated on me, so it will produce a significant amount of cash. And normally, I would just roll it into, an index, one of the index funds that I already own. I should say this money will probably eventually just become my kids. So it's not really an asset allocation issue. That's why I'm just going to put it in the stock market. So I was considering as a alternative direct indexing, and with the idea that the after-tax return would be slightly higher than just a normal low-cost index fund.
Yeah, absolutely. And will you have, so this investment that's being liquidated, is this a private company or something, or in real estate?
It was a private credit investment. Essentially loaned money to a real estate partnership, and the loan's coming due, and so they're going to be paying it off.
So there's not you don't have a large capital gain you're trying to offset.
No,
okay.
No, I don't. But I've done some research on direct indexing, and I guess I've come to the conclusion that it's not a good idea in this situation, and I just wanted to run my thinking by you guys.
Yep. And why do you feel that way?
Well, okay, so it's going to be a large lump sum put into that account and probably not added to. So we'll just sit there and, like I said, eventually pass probably to my kids.
How old are you?
I'm in my mid-60s.
Okay.
And so the reason why I think it might not be a good idea is that, so again, the only reason I'm going into it is for the tax benefits. But those tax benefits, from my analysis, are going to decline over time.
That's correct.
And so after perhaps 3 to 5 years, there'll be very little tax benefit.
Yeah.
But the higher maintenance fees will continue, and these maintenance fees probably are, significantly higher than I would be paying at just like the Vanguard S&P 500. And at some point, the capital gain, the hopefully at least the basis on this investment is going to be so low. I mean, it'll step up at my death, but again, that's hopefully a long time from now. And so I'm thinking that the accumulated management fees are going to offset the tax advantages eventually, because the tax advantages are going to decline over time, while the higher management fee will stay with me forever.
Yeah, and so let's back up for the rest of the listeners. Kind of.
By the way,
you're spot on.
You're 100% correct.
I still might argue why you might want it.
But and we'll tell you a couple things that we'll touch on, that your financial situation can change and allow for gifting of those highly appreciated individual stocks to your children while you're alive, rather than at death.
But so a direct indexing, think about the S&P 500. I think most people understand an index is where an ETF or a mutual fund accumulates shares in the 500, essentially the 500 largest companies in the United States, and they have a weighting based upon how large the companies are relative to one another. So, the Apple will have a much higher weighting than some little tiny company that nobody's thinking of. That's part of the S&P 500.
They're capital weighted.
And instead of some individual saying, is this a good company to buy? Should we sell this and buy that? They say, let's forget about it. It's fool's straight. Let's just own the broad index. With direct indexing, instead of having an ETF or a mutual fund, technology creates an index for Dave. And with this, Dave might own, and maybe it's the S&P 500, maybe it's a global index where it's 80% US, 20% global, and they'll go out and buy maybe not 500 companies, but maybe 350 companies to get 98, 99% confidence level that you're tracking the index. And then it's managed for a tax basis. And typically, Dave, you can dial in how aggressive you want to be in harvesting losses. So it works really well if, let's say you've got a business that you're going to be selling in a year or two, or you're gonna trigger capital gain in the future. You can use a strategy like this and accumulate losses that you can carry forward that'll offset future gains. Or if you said to us that this lump sum you're getting right now is going to have a trigger capital gain, we'd say, look, it's great. In the first quarter of this year, you can have a direct indexing. They can accumulate significant losses for you to help offset that. It sounds like you don't have any significant gains that you're having to report on. Is that right?
Well, I mean, I can always use, losses. I shouldn't say that, but can always use losses to. I always have a use for losses. Let's put it that way. But since you're owning the individual in a direct indexing situation, you're actually owning the individual stocks. Eventually, you're going to get into this almost handcuff situation where, geez, I'm not crazy about owning this individual stock anymore, but it's got, such huge gains in it that I don't want to sell it. And you're not in, and so you've lost some of the flexibility. I mean, one of the reasons why the S&P 500 index fund over time has performed well is that it's not a static.
That's right.
It's constantly it's essentially by default taking the cream of the crop because it's taking the 500 biggest.
Yeah, but in a direct index too, it isn't just tax loss harvesting. They're gonna take gains as well, right? So they're not going to let it float out. But your big question is, and what are they charging you to do the direct index?
I checked into Schwab and Vanguard. I think it depends on the size of the account, but it starts at 0.4 and trends down.
Yes,
and that's obviously many multiples higher than you pay.
You can get it less than that. I think if you search around, and I think also that those numbers are going to decline because it's just technology. Like once the technology's built, it's plug and play. So
it will get less expensive over time. And we didn't talk about this 4 or 5 years ago because it wasn't really available. If there's fresh cash coming into a portfolio, we would always prefer direct indexing because even at associated costs with a higher management fee.
With taxable accounts, not retirement.
Oh, correct.
Accounts.
With taxable accounts. That even that
not
higher management
typically never using it.
Okay, fair enough, Scott. Fair enough.
I mean, I'm just thinking of situations. Not always,
but it's the first place we would go as an alternative. That fee is going to be higher. But if you're gifting to charity at all, then you use those appreciated assets in those individual stocks.
That's where it becomes really powerful for those that are having some sort of gifting strategy as part of their estate.
And the other thing is that you may decide to start gifting to your children while you're alive rather than waiting until you pass away, you or your spouse. And if they're in a lower tax bracket, then you gift appreciated shares out of that individual. You can identify the shares. You can gift it to whoever you want. And then when they liquidate, they pay it at a lower basis. Obviously that gain still needs to be paid. The taxes on it need to be paid. But it's a great technique to actually move from one tax bracket to another if you're gifting to someone that is in a lower marginal tax rate than you.
But you could do the same thing with an index fund. I could gift shares of an index.
Yeah, but you don't have the same.
But you don't have the same benefit
you don't have
because
the losses.
You're gifting losses inside that portfolio as well. So an index
in 10 years, there's probably not going to be losses.
No, there
any significant losses.
There'll be losses on those individuals inside of that 500. There will be losses in that because it's constantly, as you said, it's constantly changing.
And
so
they're
buying and selling.
They'll trigger gains as well. And again, you can dial in how aggressive you want to be with the losses. So if you don't need to be terribly aggressive, you don't have it. You structure it so it's not terribly aggressive.
But over time, you're correct. It becomes harder and harder to manage that portfolio because there's the embedded gains become. But it's still at 40 basis points.
I do it for myself.
I don't have any. I don't have any fresh cash. I don't have any money in direct indexes because when I invested the money, the best option was index. If you gave me fresh cash today, it would be 100% into a direct index.
Even if you weren't going to do anything with it for 20 years.
That's correct. That is 100% correct.
I mean, I think you can get lower cost than 40.4%. And 2, I think the cost is going to come down in time. And 3, you can always stop. I don't want to pay this anymore.
Yeah, but then you're stuck.
That's
with,
right. Then you're no longer mimicking the index.
That's right.
Yeah, I guess the other thing I was surprised about, and this, I was surprised at the net advantage, I guess, the return advantage, or the amount of losses actually thrown off on average each year. We're only like 100 or 200 basis points of the portfolio.
That's significant.
Then you take, and the value of that is maybe 30%, 30% of that in terms of tax losses. And then it declines over time. I hear what you guys are saying. I'm just, I'm not sure the handcuffs. I'm not sure.
All right. Okay, good.
I'm not sure the juice is worth the squeeze.
Well, then don't do it. I mean, it's not that big of a deal relative to everything else. Like it's not going to have any impact, frankly, on your lifestyle. Most likely will not have much impact on what your net worth. I think we could run some analysis, but my guess would be that 10, 20 years out, your net worth would be a little higher if you use that strategy. But
okay, I appreciate that.
Yeah. Either way, it's not going to. I mean, it's.
Yeah.
By the way, I know. I think he's your COO, Pete. Great guy, by the way. I coached one of his boys in lacrosse.
Oh,
so,
did you?
Good.
He's. I always enjoyed talking. That's actually how I got to kind of turned on to you guys.
Oh, I appreciate that. Yeah, he is a good guy.
Shout out to Pete. So.
All right. Well, thanks, Dave.
All right. Well, thanks for your,
It's not like this is the silver bullet and life's going to be much different.
But it's just more efficient.
Yeah.
Even with the added cost.
Appreciate the
Scott,
cost.
you're correct. The cost, we've seen them come down already.
Yeah.
In the relatively few years that they've
That's
actually,
right.
and what caused them to come down was computing power and the fact
And
that
competition.
competition, and that there's no cost to trade.